On January 1, 2026, China rolled out a regulation that almost nobody in Western financial media covered properly. Effective that day, the entire export of silver out of China was restricted to 44 government-licensed companies, down from hundreds. Silver was officially reclassified as a strategic critical mineral, joining the same legal category as rare earths, tungsten, antimony, and gallium. For comparison, under that same Ministry of Commerce framework, only 15 companies were permitted to export tungsten, only 11 for antimony. Silver got 44, a relatively wider list but still a fraction of the previous market. 2 months after the regulation took effect, China imported 836 tons of physical silver in a single month. That is roughly 2.7 times the 10-year seasonal average for March. The first quarter of 2026 set a historical record. Over 1,600 tons pulled into China in 3 months. At the end of January, the Shanghai silver reference price traded almost $17 per ounce above the London benchmark. That premium has not closed. Asian buyers, predominantly Chinese-aligned, are paying record amounts for physical silver. This is the same regulatory playbook that drove rare earth prices up multiples in 2010 and gallium up 365% in 2024. Silver is the next material on the list. Here is exactly what happened, how the playbook works, and what the historical precedent tells us happens next. Quick note before we dive in. Nothing on this channel is financial advice. We're covering the news, the data, and the history. Everything you watch is for educational purposes only. With that said, here we go. To understand what's happening in 2026, you have to understand something most Western analysts skip. China's monetary relationship with silver is not a recent development. It is older than the United States by roughly 2,000 years. For most of the period between the Han Dynasty and the early 20th century, silver was the de facto monetary standard inside China. Imperial taxes were paid in silver. Wages were measured in silver. The Ming Dynasty, from 1368 through 1644, formalized silver as the country's primary store of value. The Qing Dynasty extended that practice for another 260 years. When European traders arrived seeking access to Chinese goods, tea, porcelain, silk, they discovered that China would only accept payment in one currency: silver. The silver flow into China during the 16th and 17th centuries was so massive that some economic historians estimate 1/3 of all silver mined in the Americas during the entire colonial period ended up in Chinese vaults. It was the single largest commodity flow in human history at the time. By the early 1800s, that imbalance became politically intolerable for Western powers. The British couldn't afford to keep paying silver for tea. Their response was to push opium into China, specifically because opium could be sold inside China for silver, reversing the flow. That trade triggered the First Opium War in 1839 and the Second in 1856. Both wars were fundamentally about silver, about who controlled it and how it moved. China didn't formally abandon the silver standard until 1935, under intense pressure from the United States Silver Purchase Act of 1934, which had distorted global silver prices and effectively bankrupted the Chinese monetary system. Within 90 years of that abandonment, meaning today, China has rebuilt its position in silver from a different direction. Not as a monetary store, but as the industrial refining hub of the entire global supply chain. Here is how that happened. Starting in the early 1990s, China invested aggressively in silver refining capacity. Most silver is mined as a byproduct of copper, lead, zinc, and gold mining. The unrefined output is called doré, an alloy that requires further processing to become the 0.999 fine silver that markets use. Refining is energy-intensive, capital-intensive, and historically distributed across Mexico, Peru, Canada, and several European countries. Over the last 3 decades, China consolidated. Major Chinese refineries, including some operated by state-owned firms, built scale that undercut Western competitors on cost. Mining countries like Mexico, Peru, and Australia found it economically rational to ship doré to China for processing, rather than maintain their own refining capacity. The result, by the mid-2020s, and according to industry estimates from analysts including Kotak Mutual Fund and FX Street, China refines somewhere between 60% and 70% of all the silver that flows through the global market. Even silver that is mined in the Americas frequently passes through Chinese refineries before it reaches an industrial buyer or an investor's vault. This is the structural position China starts from, and it is the position that makes the January 2026 export restriction so consequential. Inside China, silver gets consumed in 5 major channels. 4 of them are growing. Number 1. Solar panels. China today manufactures roughly 80% of the world's solar capacity. The biggest players, Jinko Solar, Longji Green Energy, Trina Solar, JA Solar, Tongwei, ICO, collectively shipped hundreds of gigawatts of modules in 2025. Jinko Solar alone is targeting between 75 and 85 gigawatts of shipments for 2026. Each modern solar module uses silver in the conductive paste that carries electricity through the cells. Newer back contact modules, the high-efficiency designs that Longji, ICO, and others are rolling out, use approximately 110 to 120 milligrams of silver per cell. According to Bloomberg NEF, total global photovoltaic silver demand for 2026 is approximately 194 million ounces. The majority of that demand is met by Chinese manufacturers, which means the majority of that silver gets consumed inside China before it ever reaches global investor markets. The economics of that consumption are now actively forcing strategic decisions. Longji Green Energy, one of the largest solar manufacturers in the world, disclosed a fiscal 2025 net loss of 6.4 billion yuan, roughly $890 million, and the company explicitly cited the sharp rise in silver paste and silicon costs in the fourth quarter. Multiple Chinese solar firms entered 2026 with similar losses. The industry has responded by announcing accelerated transitions to base metal alternatives. Longji announced it will begin mass production of copper-based PV modules in the second quarter of 2026. That is the magnitude of the silver pressure. The largest Chinese solar manufacturers are restructuring their supply chains to use less silver because silver costs are eating their margins. Number 2. Electric vehicle electronics. Modern EVs use significantly more silver than internal combustion vehicles, particularly in battery management systems, charging connectors, and high-voltage inverters. China produces more electric vehicles than the rest of the world combined. Number 3. Consumer electronics and AI data center components. Silver is used in printed circuit boards, contacts, and high-conductivity wiring throughout modern electronics. China assembles most of the world's smartphones, laptops, and, increasingly, the server hardware powering global AI infrastructure. The AI build-out specifically has surged industrial silver demand to levels nobody was forecasting 2 years ago. Number 4. Retail investment. Chinese retail buyers have been accumulating physical silver at record pace. According to the World Silver Survey 2026, global coin and bar demand is forecast to rise 18% in 2026, the highest level since 2022. Asian buyers, predominantly Chinese-aligned, are paying record premiums for physical metal. Number 5. Jewelry. This category fell 8% in 2025 to 189 million ounces and continues to decline as Chinese consumer preferences shift toward gold. Add it all together, industrial silver demand in 2025 was 657.4 million ounces, 58% of total global silver demand. That number is heavily skewed toward Chinese consumption. Retail demand is rising rapidly inside China, and the silver that enters China through customs imports, over 1,600 tons in Q1 of 2026 alone, is not flowing back out. Here is what actually happened on January 1st. On December 30th, 2025, China's Ministry of Commerce published its formal regulation on silver export licensing. The regulation became effective 2 days later, on January 1st, 2026. Reuters confirmed the move on December 30th. CNBC carried it on December 31st under a headline that read, quote, "China to restrict silver exports, echoing rare earths playbook." The legal mechanism is technically called a strategic critical mineral export licensing regime. In practice, it does 3 things. First, it formally classifies silver as a strategic critical mineral. That is the same legal category China uses for rare earths, for tungsten, for antimony, for graphite. Once a material has that designation, the central government has broad authority to control its movement. Second, it requires every export of silver out of China to be conducted by a licensed company. The Ministry of Commerce names which companies are licensed. As of January 1st, 2026, That list contained 44 entities. By comparison, the same regulatory framework allowed only 15 companies to export tungsten, only 11 to export antimony. Third, it requires every shipment of silver to be individually approved. Even a licensed company cannot simply ship silver abroad. Each export transaction requires a specific permit. The Ministry of Commerce can grant the permit, delay it, or deny it. This is not a full export ban. China has not stopped silver from leaving entirely. What it has done is install a regulatory choke point. Every silver shipment out of China now requires explicit government approval. The pattern is identical to what China did with rare earths in 2010, and again in 2023 and 2024 with gallium, germanium, antimony, and graphite. We're about to walk through exactly what happened in those cases. But before we do, one detail worth noting. The regulatory framework that imposed silver licensing did not list explicit volume quotas or country-specific destination restrictions in its initial publication. That matters. The 2010 rare earth restrictions also did not start with quotas. The 2024 gallium and germanium restrictions evolved over multiple stages. Initial license requirement in August 2023, then a full destination-specific ban on the US in December 2024. Silver is currently in Phase 1 of the same playbook. What we don't yet know is when, or if, China escalates to Phase 2. Here is what happened the last 2 times China did this with another strategic material. The first precedent is 2010. In September of that year, a Chinese fishing boat collided with Japanese Coast Guard vessels near the Senkaku Islands, a territorial dispute zone in the East China Sea. Japan arrested the Chinese captain. China demanded his release. When Japan held the captain for several weeks, China responded by quietly halting rare earth exports to Japan. The cut was not officially announced. Chinese customs offered no public explanation. Shipments simply stopped at the dock. Japanese end users, magnet manufacturers, electronics producers, defense contractors, discovered they could not source rare earth elements from their normal Chinese suppliers. The price effect was immediate and brutal. Cerium oxide, used in glass polishing and catalytic converters, went from approximately $4.70 per kilogram in April of 2010 to $36 per kilogram by October. That is a 7.7 times increase in 6 months, roughly 660%, and cerium was on the milder side of the move. Other rare earth elements rose comparably or more. The embargo on Japan lasted roughly 2 months. The price effects lasted years. Japan responded by investing heavily in supply chain diversification, particularly building rare earth recycling capacity and securing alternative sources from Australia, Vietnam, and India. The World Trade Organization ruled against China in 2014. China formally dropped its export quotas in 2015. But Japanese dependence on China for rare earths had been 90% before the dispute. 15 years later, Japanese dependence is approximately 60%. That is the structural lesson from 2010. The price effect from a Chinese strategic material restriction does not reverse just because the restriction reverses. The supply chains restructure permanently. The second precedent is more recent, and the silver parallel is much more exact. In July of 2023, China's Ministry of Commerce announced new export controls on gallium and germanium, 2 metals used heavily in semiconductors, solar panels, and advanced electronics. The first version was a licensing requirement. Exporters needed ministry approval. The licensing framework took effect in August 2023. The immediate price response, monthly US dollar value of gallium and germanium exports from China, declined 12% in the months after licensing took effect. Importers outside China scrambled to find alternative sources and paid significantly higher prices to do so. Then in December of 2024, China escalated. On December 3, 2024, the Ministry of Commerce issued a directive that explicitly banned exports of gallium, germanium, antimony, and certain super-hard materials to the United States. The price response on the second escalation was even more severe. According to data compiled by the Swedish National Center for China Studies, gallium prices in Europe rose 365% following the controls. Unwrought gallium exports were near zero throughout 2025. Germanium exports fell sharply. The U.S. Geological Survey estimated that a full restriction of Chinese gallium and germanium would reduce U.S. GDP by approximately $3.4 billion. Antimony prices roughly quadrupled, rising approximately 250% over 2024 per Reuters and CSIS coverage. In November of 2025, the U.S. gallium and germanium ban was suspended as part of a broader trade negotiation. But the underlying licensing framework remained in place. This is the same regulatory architecture China just applied to silver. With both precedents established, let's look at what silver is showing right now in May 2026. The Shanghai Gold Exchange silver reference price has been trading at a persistent premium to the London Bullion Market Association benchmark since January. At the end of January 2026, that premium peaked at almost $17 per ounce above London. Mid-January, it was around $10, roughly an 11% gap. As of recent reporting, that gap is still in the $10 to $20 range. It has not closed. A $10 to $15 persistent premium between Shanghai and London is not normal arbitrage. Under normal market conditions, traders would buy silver in London, ship it to Shanghai, sell it at the premium, and capture the difference. That is the textbook trade. The reason it's not happening in 2026 is the export restriction. The choke point is one way. Silver can flow in, but not freely back out. Inside the United States, COMEX silver registered inventory currently stands at approximately 80 million ounces. Open interest in silver futures stands at 519 million ounces, 6.5 times more paper claims than deliverable physical metal. The delivery coverage ratio sits at 15.4%. Anything below 15% is considered squeeze-stress territory, historically rare in modern markets. We are at the threshold. In London, the LBMA's most recent vault report shows 27,065 tons of silver held in approved facilities. Kitco's April 23 coverage of the silver market carried the headline, quote, "London silver is running out of room." The World Silver Survey 2026, released April 15th, confirmed that structural physical pressure is at multi-year highs. The Silver Institute's annual report for 2026 forecasts a total market deficit of 46.3 million ounces, the sixth consecutive year of structural shortage, and a 15% increase from 2025's 40.3 million ounce deficit. Total global silver supply for 2026 is forecast at 1.05 billion ounces, a decade high, and yet still less than total demand. The 2025 silver price, by the Silver Institute's accounting, rose 147%. That was the largest annual gain on record going back to 1983. In May of 2026, spot silver sits at $87, having touched $110 per ounce briefly in late January. Every data signal, supply, demand, physical flow, premium gap, COMEX coverage, is showing the same picture. Silver is structurally short. China is consuming most of the world's refined supply. And the export valve is now controlled by license. Here is the part that most market commentary is missing. When China imposed rare earth restrictions in 2010, the world had been buying rare earths from China for over 2 decades, on the implicit assumption that supply would always be there. The 2010 cut shattered that assumption in a matter of weeks. Within months, rare earth prices rose hundreds of %. Within years, the entire global supply chain restructured around the premise that Chinese material could be cut off at any time. When China escalated to a full gallium and germanium ban in 2024, the same assumption pattern repeated. The ban produced a 365% price increase in Europe, a 3.5 times move in materials cost, and significant industrial disruption for everyone downstream. In both cases, the structural pattern was identical. Step 1. China formally classifies a material as strategic. Step 2. Licenses get restricted to a small number of named entities. Step 3. Domestic prices in China stay flat or decline because supply is sealed in. Step 4. Prices outside China rise dramatically because the global market has to find alternative sources, and those alternatives are smaller, more expensive, and slower to scale. Silver entered Phase 1 on January 1, 2026. Silver is now in Phase 2. 44 licensed exporters, persistent Shanghai premium, record import flows. We don't know exactly when Phase 3 and Phase 4 arrive. It's worth noting one prominent counterview from inside the silver bull camp. Rick Rule, one of the most respected mining finance veterans alive, recently disclosed that he sold roughly 80% of his personal physical silver position and rotated the proceeds into silver mining equities. His thesis is not that silver is overvalued. It is that the next phase of the move comes from miners outpacing physical, the same way miners outperformed spot in the second half of the 2011 peak. That is not financial advice. That is a documented contrarian position from a credible voice, worth knowing about as part of the full picture. What's worth watching over the next 90 days? Shanghai London Silver Premium, currently around $10 per ounce. If it widens past 15, the global market is signaling severe physical scarcity. If it compresses below 5, the choke is loosening. April and May Chinese customs data. The March 2026 number of 836 tons was nearly 3 times normal. If April and May come in at similar levels, China is sustaining a 1,000-ton plus monthly import pace. The world cannot sustain that without a price response. COMEX silver registered inventory and coverage ratio. Currently 80 million ounces and 15.4%. Any further decline pushes the system into stress territory below 15. LBMA Silver Vault Holdings. The April 2026 number was 27,065 tons. The next monthly report will tell us whether London is continuing to lose silver or stabilizing. And Ministry of Commerce announcements. Any tightening of the 44-company exporter list, any quota imposition, any destination-specific restriction, is the signal that Phase 3 has begun. That is the exact regulatory move China made on gallium in December of 2024. We are not predicting what happens. We are describing what is already happening, what the precedent shows about how it usually unfolds, and the specific data points that will tell you which phase we're entering. If you found this useful, subscribe and follow how it develops. We cover the data, the policy, and the history that almost nobody else is connecting. See you in the next one.